In this series of videos, we're going to learn all about bank reconciliations. In the first video, we'll learn what a bank reconciliation is and why it's important in accounting. In the second video, we'll prepare a bank reconciliation based on a sample problem. In the third video, we'll look at the journal entries related to bank reconciliations. But let's start by talking about what a bank reconciliation is. So a company will keep track of its cash, and typically, as we've learned in this class, one way of keeping track of our assets is by preparing T accounts. So a company might prepare a T account and they'll list all the debits to cash where they've got cash coming in, all the credits to cash, which of course represent cash outflows, and at the end of the month they'll total up, they'll take the debits minus the credits, and they'll figure out, okay, how much money do we have? And that of course resides on the debit side of the account because cash is a debit account. At the same time, and this is why bank reconciliations exist, another outside organization is keeping track of the company's cash. So for most assets, if I think about a company's accounts receivable, for example, they have to keep track of their accounts receivable and nobody else will do it for them. But with cash specifically, there's an outside organization keeping track of it for them. And that outside organization is their bank. So their bank every month will prepare and send out a piece of paper to them. And that piece of paper is one that you receive as well if you have a checking account or a bank account. It's called a bank statement. You might receive yours online, but most companies will actually receive paper copies of their bank statements. And so they have their own record of cash here on the left, and at the same time, they have the bank keeping track of their cash for them. And on the bank statement, it'll show their deposits and their withdrawals for the month. And at the end, the bank will say, hey, here's how much money you have. So if I were to look at my cash T accounts for, say, May 31st, or look at it on May 31st, and I were to look at a bank statement for the month of May, so dated, again, May 31st, one might think that these two items, my balance according to my bank statement and my balance according to my cash T account, one might think that they would match. Well, I'm here to tell you these items will never match. And this is not a problem. This isn't cause for alarm. This doesn't mean somebody's stealing money or we haven't done proper accounting. All this means is we have to, as accountants, be able to explain the difference. Why might my cash account differ from the bank's record of my cash? And the reason it's so important to explain is because if there's unexplainable differences, that means we've got a problem. That means there's an error that could be a sign of theft, but it's a problem if we can't explain it. But most often, the differences are very much explainable. And there's two broad reasons why we have differences, why our cash T account doesn't equal our bank statement. And so broadly, the reasons go like this. First, there's items we've recorded, and I'll say that's on our books, on our records, that the bank has not recorded. And I'll put yet in brackets because they will. And so let's talk about this for a moment. Items that we've recorded in our books that the bank hasn't recorded yet, how does that make sense? Like, what's an example of an item we've recorded that the bank won't have recorded? Well, the most common item that would fall here would be called an outstanding check. What does that mean? Well, let's say I receive my cable bill, okay, and it's May 28th, and I get my cable bill. It's for $100. I say, yes, I owe $100, and I'm going to pay it, and I pay it right away. And I don't use online banking. Many companies don't. In fact, most companies don't. Most companies actually write a check to pay their bills. And so we decide we're going to write a check. So it's May 28th. I lick the stamp. I lick the envelope. And I send in my check to pay my bill. Well, when that happens, of course, I'm writing a check. And when I write the check, I immediately credit cash for the $100. My debit here would be to like cable expense or something like that. But I'm not worried about the debit. I'm worried about crediting cash. So I credit cash for $100. And so when I go up to my cash T account, somewhere in this list of credits, I've got a credit for $100 to say, oh, I wrote a check to pay off my cable bill. Now, remembering that this is the cash T account for May 31st, and this is my May 31st dated bank statement. What's very likely to happen with this check is I write it on the 28th, I lick the stamp, the post carrier doesn't get there till the 29th, it doesn't arrive at the cable company for 3 days, and now by that time it's June. Well, on my May 31st bank statement, the bank's not going to know about that check yet, right? They don't know about the check until the other party has deposited the check in their bank account. So they won't know about it until the cable company tries to draw on the check. Because of that little timing difference, I write the check on the 28th and maybe the cable company cashes it on June 2nd. Because of that timing difference, there's going to be a difference in these accounts. I'll show a credit to cash of $100, but there's going to be no corresponding withdrawal from my bank statement. That'll appear in June. So that's an item that I've recorded. I've said, oh, credit cash $100, but the bank doesn't know about it yet. The other common example here is called a deposit in transit, also called an outstanding deposit, but deposit in transit is the more widely used name. So what's a deposit in transit? Let's say I'm a cash business. I have a lot of customers coming in and paying me money. And so every time they pay, I debit cash, debit cash, debit cash. But let's say I don't take that money to the bank immediately. Well, I've got a situation where in my cash T account, I'm going debit cash, debit cash, debit cash. But if it doesn't go to the bank right away, it means it's going to be a difference, right? I'm debiting cash on my side. Well, the bank doesn't know about it until I actually bring it into the bank. So that is called a deposit in transit. And those are also fairly common, but much less common than outstanding checks. Outstanding checks, you'll see dozens on a typical big company bank reconciliation. Outstanding deposits or deposits in transit, you might see one or two, but not many. So, big category here. These are items we've recorded, but the bank has not yet recorded. Now, here's our other big category of reasons that these might be different. And this is for items recorded by the bank that we haven't yet recorded. So these are things that the bank has recorded, but we haven't gotten to yet for one reason or another. What's an example of this? Well, the most common example that you would see on every bank statement, you get to the very bottom of the bank statement, and if you're like me, you don't have a lot of money in your bank account, you look at the bottom and it says, hey, you got 4 cents worth of interest. Like, congratulations, 4 cents worth of interest, not a lot of money. But when I'm keeping track of my transactions for the month and I'm going debit cash for all of my customers paying me and things like this, one of the items I won't record as a debit to cash typically is the interest on my bank account. Now, when I get the bank statement, I go, oh, look at that, I got 4 cents of interest. Let's have a parade. It's very exciting. But it's something that I won't likely have recorded in my cash T account. So that's something on the bank statement that differs from my cash T account. So that'll be somewhere down here at the bottom, and it'll be something that needs to be recorded here on the cash T account, but I haven't recorded yet. So an example is interest on account. A similar example here would be bank charges, right? Very often, a company won't record their bank charges until after they've received their bank statement so they can see what the bank charges were. Other common examples, EFTs, electronic funds transfers. So every month I have a mortgage payment that comes out of my bank account automatically. Companies' accounting systems are built around getting invoiced for stuff. They get the invoice, they pay the invoice, they record the journal entry. Well, if it automatically is coming out of the bank, they may not have recorded it. So that might appear on a bank statement, but not in a company's own records. A final example of something that may not be recorded is if a customer bounces us a check. NSF checks, which are non-sufficient fund checks. And that's another example of something the bank may have recorded that we may not have. In our next video, we're going to walk through an example of how to prepare a bank reconciliation.